What exactly is a follow-on public offer? Simply put, an FPO is a process by which a company that is already publicly listed on a stock exchange issues additional shares to investors. Think of it as a sequel to the initial public offering, or IPO. Companies use FPOs for a variety of reasons. They might need to raise capital to fund new projects, expand operations, pay off debt, or even acquire other companies. It's a way for them to get more funds without taking on more debt. There are two main types of FPOs, and understanding the differences is crucial for any investor. Let's break them down. First up, we have the dilutive FPO. This occurs when a company issues new shares, which increases the total number of shares outstanding. While this can dilute the value of existing shares, it's often used to raise capital for growth opportunities that can benefit the company in the long run. The second type is the non-dilutive FPO. In this case, existing shareholders, such as company insiders or large investors, sell their shares to the public. No new shares are created, so the total number of shares remains the same. This type of FPO doesn't dilute the value of existing shares. Both types of FPOs have their own advantages and considerations. For instance, while a dilutive FPO can potentially reduce the value of your shares in the short term, it might lead to long-term gains if the company uses the funds wisely. On the other hand, a non-dilutive FPO doesn't change the share count, but could signal that insiders are cashing out, which might raise some red flags for investors. Here's how an FPO generally works. 1. The company files the necessary documents with the regulatory authority. 2. A price band for the shares is set. 3. Investors bid for the shares within this price range. 4. Shares are allocated based on demand. 5. Finally, the shares are listed on the stock exchange for trading. Now, let's talk about what this means for investors. The benefits of participating in an FPO include the opportunity to buy shares at a potentially lower price and to invest in a company's growth. However, there are risks involved too, such as market volatility and the potential dilution of shares. Always do your due diligence before investing. To give you a better idea, let's look at some recent examples. Vodafone Idea have successfully raised funds through FPOs. These cases highlight how companies leverage FPOs to fuel their growth. And there you have it, a quick rundown of follow-on public offers. If you found this video helpful, make sure to give it a thumbs up and subscribe to Goodwill Wealth Management for more financial insights. Hit the bell icon so you never miss an update. Have questions or thoughts about FPOs? Drop them in the comments below. Thanks for watching.